All right, my next guest says that there is going to be a big rebound in risky assets. Wonder if that includes real estate. Joining me now from San Antonio, we have Derrick. He's the Director of Research at U.S. Global Investors, where he helps oversee about $2 billion worth of client money. John, it's good to have you with us. Let's start off just talking about this idea of what exactly are risky assets. I mean, would real estate in Silicon Valley, would that qualify as a risky asset these days?
Yeah, I guess it would, Pimm. It would be a risky asset. But I think risky assets are generally going to be, equities, commodities, could be real estate, those kind of things. And I think my thought process is we're at the very early stages of a global easing cycle. Really started back in December with this LTRO program from the ECB. The ECB is taking the role of what the Fed did in 2009. And then you also have just emerging markets around the world starting either cutting rates or cutting reserve requirements for the banks. You have the Fed here saying they're going to be on hold for almost 3 years. And so you're at the very early stages of this global easing cycle. That's typically when you want to own equities or risky assets in general.
All right, well, let's talk about one specific equity, Apple. The stock was up today, I think more than 3%. The stock last year up 25%. More oomph left in Apple?
Yeah, I think so. If you look at it, it trades at roughly 11 times forward earnings. Earnings are going to grow over 50% this year, and that may even be conservative. Obviously, in their last earnings report, it was a blowout number. There's a lot of momentum in the business. The stock's really not expensive, even though it's the largest market cap stock I think in the world right now. And so I think if you want to own risky assets or you want exposure to the market, I think this is just an excellent example. The stock has run up a little bit. Maybe you can wait for a pause or a pullback, that kind of thing. But definitely, I think over the course of the year, it's something you're going to want to own.
Well, if you think that Apple is something that you want to own, what about that whole ecosystem? I mean, it's got to run through servers. I mean, does this mean chip companies as well as software providers and app developers just put your money into technology?
Well, I think, the whole thesis of, at the beginning of an early, kind of easing cycle, early stage of an easing cycle is you want to be in cyclical assets. You want to be in cyclical areas. So technology, generally speaking, is definitely a cyclical area, but also energy, commodities, even, retailers, those type of things. So that's where you want to have the bulk of your assets for 2012. All
right. Well, let's combine two concepts having to do with risky. Investing in Russia and energy. Gazprom. It's about 10% of total Russian GDP. This isn't a country. This is a major entity in the lifeblood of Russia. Why do you like the shares of Gazprom?
Well, one, they trade at about 3 times earnings, so I think there's very little downside risk here. I think the issue is that just as we've seen emerging markets really explode so far in January or so far this year, we've seen, if you want to own risky assets, Russia would be a classic one, right? And so it's going to be higher beta, but the stock is very cheap. Russia has some elections coming up in about a month. There's going to be some noise around that, but I don't think it's going to be a game changer in Russia. I think you want to own Gazprom because there's a little bit of downside and quite a bit of upside if things go right. Oil prices could be higher, commodity prices in general could be higher, and that's why we like it.
Tell me about gold. As I said, gold price is up about 10% so far this year. What do you think about investing in gold mining shares?
Well, it's an area we like, Pimm, and basically we've seen it kind of goes along with the theme of very stimulative monetary policy around the world. The Fed, this LTRO program, the Fed or the ECB introduced back in December. Another tranche is coming at the end of the month. They're talking, potentially $1 trillion. They had the, essentially the ECB encouraging banks to take down as much as they want. So it's a very QE type of move, and it's very reminiscent to what happened in 2009 with the Fed. And so I think if you look around the world, you have, currency debasement, you have negative real interest rates, and both of those dynamics offer gold's upside. This is an environment where gold should do well.
And John, you like the shares of Randgold. Tell me why.
Yeah, Randgold, they recently reported, they had a good report, produced about 700,000 ounces last year. Over the next few years, that's going to roughly double. They're talking about maybe 1.2 million ounces or so by 2015, and they're in the right part of the cycle. So you want to own companies that are increasing production, increasing reserves. They're in the sweet spot where they're ramping up production at mines. And so if you think about it, output's going to roughly double over the next 3 years. Cash costs should come down over that period of time. time. Maybe in 3 years, you're looking at maybe $525 an ounce. Even in the current environment of $1,700 gold, that looks pretty attractive.
And even we've got a time constraint. I want to thank you very much, John Derrick, joining us from U.S. Global Investors.